Morning, everybody. Good afternoon, good evening, wherever in the world you're at. Thank you for stopping by. If you're subscribing, welcome. For those who are coming back, today is our investment day, so we're going to talk about some type of accounts that you can invest in and why you would and what's going on. And I'm going to go off the screen so you can hear me in the background. I will be talking, and hopefully you'll be listening. Right? So early 2022 was a period most investors would like to forget. Stocks slumped. Okay, now this is being recorded on June 19th, 2022. So I don't know when you're watching, but the numbers and things I'm going to give you apply to June of 2022. So the bond market suffered the worst. We're getting ready they just increased the interest rate to like 5.34%, some crazy amount after we've had like super all-time lows. So we had like 2.34 about 2 years ago, and now we're up to 5.34 in 2022. So we'll see what happens. Hopefully it'll go back down a little after the economy calms down. So there was no shortage of culprits. The soaring energy prices, we got rising inflations, the interest rates I just talked about. We got geopolitical at risk because of the Ukraine war. So we made it through the COVID, and now we got to make it through the economy. Moreover, the Federal Reserve Board, which underestimated the extent of the inflation, is swiftly pivoting to a hawkish monetary policy. The Fed is laughable, far behind the curve, says Spencer Lerner, head of the multi-asset solutions at Harbor Capital Advisors. He expects that certain banks to jack up the federal funds rate for overnight loans, which has already happened, by the way. At the same time, the Fed will flip the massive bond buying program known as quantitative easing, which it favored during COVID economy, to quantitative tightening. That means shrinking its bloated balance sheet by tens of millions of dollars each month by letting some of the bonds mature without replacing them. If you're into bonds, then you'll know what I'm talking about. So even selling them in the market. Quickly, central bankers can tame the inflation, whether they send the economy into a recession, is a debate right now in June of 2022. So the market turbulence has tossed up some interesting opportunities for income-starved investors, particularly at the end of the curve. Yields are becoming respectable for the first time in at least a couple of years. The interest rates on short-term IOUs have moved up in anticipation of the looming Fed rate hikes. As of now, they just did increase. Weaker stock prices combined with strong corporate earnings and dividend increases have created some opportunities in income stocks. And that's what we're going to talk about on this video. I'm going to put some things up here if you're interested in diversifying your portfolio. The energy shortages, the surging prices have made oil and gas pipelines, including the master limited partnerships, a hot sector again. And so we're going to help you identify some income-producing investments in 8 different categories. This will probably be broken down into 2 different videos because it's kind of long, and I don't want to lose half of you. So I'm going to go over some fairly ordinary securities to ones that more may be on the exotic side. And I didn't just make this up on my head. I'm getting my resources from Morningstar Direct, Wells Fargo Investment Institute, the Bloomberg, National Bureau of Economic Research, Summit of Money Magazine, the U.S. and Global Markets. All these things down here are our sources. So don't think I'm just making this stuff up off the top of my head. So before you embark on your quest for income, keep a few considerations in mind. Prior to investing, you should have a plan in place that stipulates your appropriate long-term portfolio. I mean, everybody's situation is different, but generally you should ensure that you have enough cash or cash equivalents on hand to cover at least 6 months of living expenses. Okay, so the first one we're going to talk about is short-term accounts. I'm going to give you some ideas on 0 to 2% short-term accounts. And yields on the short-term fixed income accounts and securities follow the Fed's short-term interest rate. So whatever their interest rate is what it will be. That means yields available on CDs, banks, savings, money market accounts, short-term treasuries have moved off the floor and they are rising. Okay, let me give you the risk of short-term accounts. In today's inflationary environment, the money you build in cash reserves and other liquid assets loses the purchasing power. So consumer price inflation is above 8%, and the bond market projects an inflation rate of nearly 5% over the next year, as inferred from the difference between inflation-protected and nominal Treasury yields. So safe cash equivalents are needed for emergency reserves to meet the short-term liabilities such as taxes or tuition payments. But this is a time to assess whether you're socking away too much cash. So how to invest in short-term accounts. The good news is that yields available from short-term accounts such as money market accounts should keep you rising this year. There will be a world of opportunity. Let me see if I put my bonds and my indexes up here. I thought I put some money market funds up here. Money market funds, maybe not. Money market funds. All right, maybe I didn't. All right, let's go back to this if you want to look at these. These are some bond funds. We just talked about bond funds. So there will be a world of opportunity in short-term assets as the Fed hikes rates. In anticipation of higher yields down the road, you might consider keeping maturities short on CDs and durations for a measure of interest rate sensitivity. That you might want to consider keeping low on bonds and rolling over the proceeds as they mature into higher yielding instruments. And some examples of these would be the yield on Vanguard Federal Money Market. The symbol is VMXX if you're looking it up. This should rise steadily this year, partly because there is a time lag between the Fed moving and the yield moving in the money market portfolio. The FDIC-insured BASK Bank offers a 0.80% annual rate with no account minimum. Marcus by Goldman Sachs pays a 1.1% on a 10-month CD with a minimum deposit of $500. Now, you could do better with risk-free short-term treasuries because the treasury market is already priced in numerous Fed interest rate hikes over the next year. For instance, a 6-month T-bill yields 1.1%, and 1-year bills offer 1.7%, and 2-year treasuries yield 2.5%. And a year ago, which was 2021 when this is filmed, treasuries at all three of these maturities offered virtually no interest at all. So you can purchase newly issued paper at treasurydirect.gov with a minimum investment of just $100. If you prefer funds, the Vanguard Ultra Short Bond, VUSB, $49 and, no, sorry about that, $49 at 1.8%, is an exchange-traded fund that invests in investment-grade, mostly corporate bonds. Okay, this has a duration of 1, which implies a loss of roughly 1% if interest rates move up of 1%. Prices and yields generally move in the opposite direction. So Vanguard Short-Term Treasury, which is VGSH if you're looking it up, it's $59, which is 2.1%. With a duration of 2, it has no credit risk, but more interest rate risk. So note that you can lose money in bond funds such as these because net asset values fluctuate with changes in bond prices. Let me see if we talked about any of these. We talked about VMX XX, which is the Vanguard Federal Money Market, which is not on this list that I've got right up here, but that's okay. So I'm going to continue this video because I have a lot more and I don't want to make it overly long because I'll lose half of you. So on the next video, I'm going to talk about 2% mutual bonds, and I'm going to talk about investment grade bonds on the next video. So if you're interested in learning about those, you can join me back on the next video. Thank you all for watching.